The world order that your parents grew up in, the one that made the US dollar the king of global finance, kept energy prices stable, allowed America to run unlimited deficits at low borrowing costs, and promised that Western alliances would hold together indefinitely, is fracturing in real time, and nobody is connecting the specific dots that show exactly how that fracturing is going to reach into your bank account, your investment portfolio, your mortgage, and your monthly grocery bill. The Iran war did not start this fracturing. It accelerated a process that was already years in motion. The tariff chaos, the BRICS payment revolution, the European defense spending explosion, the gold price at record highs, the dollar losing its grip on global reserves, and the World Economic Forum's own January 2026 report warning that the cost of global financial system fragmentation could reach between $600 billion and $5.7 trillion. These are not disconnected headlines. They are a single coherent story about the most significant restructuring of the global financial architecture since the end of World War II, and by the end of this video, you are going to understand exactly what that means for your money. Before we go any further, take 5 seconds right now and hit the like button. This is one of the most important financial videos we have ever produced, and it needs to reach the people who are making investment decisions, career decisions, and savings decisions based on a picture of the world that is rapidly becoming outdated. Share this video with someone in your life who owns stocks, owns a home, has a pension, or simply wants to understand why the world feels more financially uncertain than it did 5 years ago. Subscribe to this channel and press the bell notification so you never miss our weekly analysis. We are here to connect the dots that the mainstream financial media is too comfortable or too cautious to connect honestly. Now let us build the complete picture of what the fracturing world order means for your financial life. Start with the number that frames everything else. The World Economic Forum, in collaboration with consulting firm Oliver Wyman, published a landmark report in January 2026 titled Yesterday's Risk, Today's Reality, and it contained an assessment that every investor and every saver needs to understand. The potential cost of global financial system fragmentation could be between $600 billion and $5.7 trillion. Yahoo Finance. That is not a theoretical future risk. That is the estimated cost of a process that WEF analysts say is already underway and accelerating. The same report noted that the trend toward increasing use of the financial system to achieve foreign policy and domestic objectives dates back decades, but was heightened following the 2022 Russian invasion of Ukraine, and that last year may have marked an acceleration in the fracturing of the global financial system. The critical phrase in that sentence is last year may have marked an acceleration. Because this year, 2026, with the Iran war shutting the Strait of Hormuz, U.S. tariffs fracturing alliances with Europe and Asia, and BRICS nations actively building the infrastructure for a parallel financial system, the acceleration is no longer a matter of debate. It is a measurable reality. To understand the full scope of what is changing, you need to understand the architecture that is being dismantled. The global financial system that has existed since the Bretton Woods Conference of 1944 and that reached its apex in the unipolar American moment of the 1990s rested on three mutually reinforcing pillars. The first was dollar dominance. Every country that wanted to participate in global trade needed dollars to buy commodities, to settle international invoices, and to hold as foreign exchange reserves. That universal dollar demand allowed the United States to borrow at artificially low interest rates, run enormous trade deficits without the currency consequences that any other nation would face, and fund its military and social programs with borrowed money at favorable terms that no other country on earth could access. The U.S. dollar remains the backbone of global finance, accounting for 56% of global foreign exchange reserves and involved in 89% of global foreign exchange market trades. Charles Schwab. Those numbers still represent genuine dominance, but the trajectory is unambiguous. The dollar's reserve share has fallen from 65.3% in 2016 to 56% today, a decline of more than 9 percentage points in a decade. And the alternative infrastructure being built to replace dollar dependency is more advanced today than at any previous moment in the post-war era. The second pillar was the SWIFT payment network, which has served as the nervous system of global finance for decades. When you send money internationally, when a corporation pays a foreign supplier, when a central bank settles a currency trade, the message travels through SWIFT, the Society for Worldwide Interbank Financial Telecommunication, which connects over 11,000 financial institutions in more than 200 countries. The United States learned during the Iran sanctions of the 2010s and the Russia sanctions of 2022 that controlling access to SWIFT was a weapon of extraordinary financial power. Cutting Russia off from SWIFT in 2022 was described as a financial nuclear bomb, but it also taught every country in the world that was not closely aligned with Washington a lesson that cannot be unlearned. Dependence on SWIFT is dependence on American foreign policy tolerance, and rational actors do not maintain dependence on a system that can be weaponized against them. The response has been the construction of an alternative financial plumbing system at a pace and scale that has exceeded most Western analysts' expectations. China's cross-border interbank payment system, known as CIPS, has been the most significant single piece of that alternative infrastructure. As of early 2026, China's cross-border interbank payment system has already processed over 45 trillion yuan, equivalent to approximately $6.5 trillion in transactions since the start of 2025. Financial content. That is not a pilot program. That is a functioning high-volume alternative to dollar-denominated correspondent banking that is already processing trillions of dollars of equivalent value in transactions that bypass the US dollar system entirely. Beyond CIPS, the BRICS bloc, which now represents Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Indonesia, Iran, and the United Arab Emirates, representing collectively approximately 29% of global GDP, 48.5% of the world's population, 72% of critical rare earth minerals, 43.6% of global oil, and 36% of natural gas production. Chronicle Journal is actively building what its architects call BRICS Pay, a decentralized cross-border payment system designed to enable transactions between member nations in local currencies without routing through the dollar system. BRICS Pay, the bloc's flagship independent payment system, is slated for full operational implementation by the late 2026 summit. Financial content. Unlike the West's SWIFT network, which relies on a centralized messaging system that is inherently subject to sanctions, BRICS Pay is being designed as a decentralized protocol that integrates national platforms, including Brazil's PIX, India's UPI, and China's CIPS, allowing member states to settle trade in local currencies within seconds. The mBridge project represents perhaps the most technically significant development in this alternative payment infrastructure. By January 2026, mBridge surpassed $55.5 billion in cumulative transaction value across more than 4,000 successful cross-border settlements. Financial content mBridge is not a messaging system. It is a settlement system, meaning it does not just transmit payment instructions the way SWIFT does. It actually moves value between central banks using blockchain technology, eliminating the need for correspondent banks and their associated fees, delays, and political exposure. The Bank for International Settlements, which had been coordinating the mBridge project, withdrew its formal participation in late 2024, specifically to maintain its claimed neutrality, but the project surged forward under the leadership of the People's Bank of China and the UAE Central Bank. That withdrawal by the BIS, the Central Bank of Central Banks, is itself a signal worth examining carefully. It suggests that mBridge has crossed from an experimental project into something that the institutions managing the existing financial order consider genuinely significant enough to distance themselves from. The Atlantic Council, one of Washington's most influential think tanks, noted in its January 2026 5 Trends to Watch report that by mid-2026, nearly 3/4 of the group of 20 will have tokenized cross-border payment systems, providing a new way to move money between countries using digital tokens, Supreme Court of the United States, and that the United States was attempting to refresh global cross-border payment standards through its G20 presidency, but that instead of converging on a faster shared system, finance ministers were diverging into incompatible national and regional approaches. The fracturing of global payment infrastructure is not a future risk. It is a present reality that is advancing faster than the institutions designed to manage global financial coordination can respond. The third pillar of the old order, and the one whose fracturing has the most direct short-term impact on financial markets and on ordinary American households, is the stability of the global energy supply chain that the United States military guaranteed for 80 years. The United States Navy has patrolled the world's critical shipping lanes since the end of World War II, and that military guarantee was the foundation of the energy pricing system, the commodity trading system, and the dollar's petrocurrency status that has underpinned American financial power since the 1970s deal between Washington and Riyadh that created the petrodollar system. When Saudi Arabia and other Gulf producers agreed to price oil exclusively in dollars and to recycle their oil revenues back into U.S. Treasury bonds, they created a permanent structural demand for U.S. dollars that gave America an extraordinary financial privilege, the ability to print the currency the world needed to buy energy, and to use that printed currency to finance American consumption and American deficits. That system is fracturing from multiple directions simultaneously. The Iran war has demonstrated with brutal clarity how fragile the physical energy supply infrastructure is, and how a single military conflict in the wrong geography can shut down 20% of global oil supply overnight. The current spike in oil prices is particularly concerning for the Federal Reserve, as it reignites fears that inflation will remain higher for longer, effectively removing any hope of interest rate cuts in 2026. CNBC, a Federal Reserve that cannot cut interest rates because an oil shock is keeping inflation elevated, is a Federal Reserve that cannot provide the monetary accommodation that debt-heavy consumers, heavily leveraged corporations, and a government paying $1.2 trillion per year in interest costs all desperately need. The energy disruption from the Iran war is not just an oil price story. It is a monetary policy story, a consumer spending story, a deficit story, and a dollar story all at once. The European dimension of the fracturing order deserves specific attention because it is one of the least reported but most financially significant stories of 2026. Europe is undergoing the largest peacetime military spending expansion in its history, driven by the recognition that American security guarantees can no longer be taken for granted and that the continent must develop genuine strategic autonomy for the first time since the end of the Cold War. European defense spending has doubled since 2019 and, under NATO's new 3.5% benchmark for 2035, could reach about 800 billion euros by 2030, roughly 2.9% of GDP. NPR Germany alone has committed to a constitutional reform that unlocks up to 500 billion euros in additional defense spending over the coming decade. In 2024, defense investments in the EU grew at an exceptional rate, increasing by 42% compared to 2023 and reaching a record high of 106 billion euros. The Hill. The financial market implications of this European defense spending surge are already visible and are creating some of the most interesting investment opportunities of the decade. Since 2022, European defense companies have substantially outperformed broader equity indices and United States peers. NPR companies including Rheinmetall of Germany, Leonardo of Italy, BAE Systems of the United Kingdom, Thales of France, and Saab of Sweden have all seen dramatic stock appreciation as the reality of sustained, multi-year defense procurement cycles has become clear to investors. McKinsey's analysis projects that the increase in European defense spending will flow primarily into equipment, supporting a broad buildup of military capability, and that deliveries from recent orders are anticipated to accelerate in 2026 and 2027 specifically, creating a near-term earnings tailwind for the defense manufacturing sector that is as well documented as any investment thesis in current markets. The broader economic impact of this European rearmament is complex and important for any investor with international exposure. Simulations show that increasing spending to meet the new NATO targets by 2035 can have a modest impact on GDP in the short term. PBS research from the European Central Bank and the Commission's own Quest macroeconomic model estimates that the defense spending increase could add 0.5% to EU real GDP above baseline by 2028. But the funding mechanism matters enormously. Defense spending financed through new government debt adds to already elevated European sovereign debt burdens. Higher defense outlays are also adding to debt pressures, leaving longer-term funding less certain, especially as EU fiscal rules return after 2028. NPR. The European defense spending story is therefore simultaneously a genuine economic growth catalyst and a fiscal risk that investors need to monitor carefully. The gold market is providing the clearest and most distilled signal about how the world's most sophisticated investors and central bank reserve managers are reading all of this simultaneously. Gold crossed $5,000 per ounce in early 2026 and has continued to move higher, surging past $5,400 in the aftermath of the Iran strikes. Central banks around the world have been net buyers of gold for 15 consecutive years, with purchases accelerating dramatically since the Russian reserve seizure of 2022 taught every non-Western central bank that dollar-denominated reserves held in Western financial institutions could be frozen by geopolitical decision. Central banks are buying gold, with their holdings now approaching levels not seen since 1965 in the Bretton Woods era. NASDAQ. That comparison is historically extraordinary. The last time central banks held this much gold relative to total reserves, the Bretton Woods system that pegged the dollar to gold was still in operation. The current buying suggests that reserve managers around the world are effectively moving back toward gold as the neutral reserve asset of choice in a world where the neutrality of dollar reserves can no longer be taken for granted. The investment implications of everything we have covered today are not abstract. They are specific and actionable. The fracturing of the global financial order creates clear winners and clear losers across asset classes and across sectors. Hard assets, including gold, silver, oil, copper, and agricultural commodities, benefit when fiat currency systems face stress and when physical supply chains are disrupted. The gold position that was prudent a year ago at $4,300 per ounce has already delivered extraordinary returns, and the structural drivers that pushed it there, central bank buying, dollar weakness, inflation hedging, and geopolitical uncertainty, have all intensified rather than diminished. Energy companies, particularly those producing hydrocarbons domestically in the United States, where production is insulated from Middle Eastern supply disruption, benefit directly from elevated oil prices, while simultaneously being protected from the geopolitical risk that is causing those prices to rise. Defense contractors on both sides of the Atlantic are benefiting from the most sustained and well-documented military spending increase in decades, with European companies particularly attractive, given the starting point of severely underinvested capabilities relative to identified needs. Mark Sobel, a former senior Treasury official, recently warned that by weakening America's economic and institutional foundations, by not being a trusted partner, the United States is undermining the underpinnings of what has given rise to dollar dominance. CNBC, that warning from a senior former Treasury official carries enormous weight because it acknowledges from inside the establishment what the data has been showing from outside it for several years. The dollar's dominance is not threatened primarily by the ambitions of China or Russia or the BRICS bloc. It is threatened by the internal erosion of the institutional credibility, policy consistency, and alliance relationships that made the dollar the natural choice for global reserve and trade settlement in the first place. While still a clear leader in the AI race, the erosion of U.S. institutions threatens its leadership of the global financial system. For now, the U.S. dollar and treasuries remain the only game in town as globally safe liquid assets, given the lack of genuine alternatives. 24/7 Wall Saint. That last phrase is the most important one for maintaining perspective. The dollar and treasury bonds remain the only genuinely liquid global safe assets. There is no alternative that is ready to replace them. The euro lacks the political unity and the deep capital markets of the U.S. The yuan lacks convertibility and the rule of law credibility that global reserve managers require. BRICS Pay and mBridge are impressive infrastructure projects, but they are years from the scale and depth needed to serve as a true swift replacement. The transition away from dollar dominance, if it continues at its current pace, is a decade-long process, not a 2026 event. But here is the critical distinction for investors. You do not need the dollar to collapse to make the right investment decisions for this environment. You need to recognize that the trajectory is one of gradual but accelerating erosion of the financial privileges that dollar dominance provided, and that the marginal shift in global reserve and trade currency patterns is already large enough to affect gold prices, treasury yields, the cost of American government borrowing, and the inflation outcomes that the Federal Reserve must navigate. The fracturing of the world order does not require a catastrophic break to be financially significant. The cracks themselves have costs, and those costs are now measurable in the data. For your portfolio specifically, the framework for 2026 is one of diversification across the fault lines that the fracturing order is creating. Maintain meaningful exposure to assets that perform well when dollar hegemony is under pressure, meaning gold, commodities, and international equities in markets that benefit from the new trade flows being created as the old order reorders itself. Recognize that European defense stocks are one of the most transparently well-supported investment theses in global markets today, with government spending commitments that are constitutionally locked in for decades in countries like Germany, providing an unusually visible and durable earnings growth path. Understand that U.S. energy producers are among the direct financial beneficiaries of a world where the Strait of Hormuz is under threat and where domestic production insulates American companies from the disruption that is inflating global oil prices. And approach high-duration assets, meaning long-term bonds and high-multiple growth stocks that are valued on distant future cash flows, with the recognition that a world of fiscal fragmentation, energy shocks, and declining dollar dominance is structurally more inflationary than the world that low-rate, low-inflation assumptions were built on. The global financial system is not collapsing, but it is changing in ways that are fundamental, that are already showing up in the data, and that will define the investment landscape for the next decade. The investors who understand the fracturing are positioning for it now. The ones who are waiting for a single dramatic event to signal the shift may wait until the shift has already happened around them. This has been your complete financial analysis of the fracturing global order and what it means for your money in 2026. If this video gave you a framework for understanding the most important structural change in global finance of your lifetime, please like it right now. Share it with everyone you know who has investments or savings that will be affected by these shifts, and subscribe with the bell notification so you never miss our next update. We will be back next week with the analysis that connects the dots that matter most for your financial future. See you in the next one.